Well, let's get back to Google's parent company, Alphabet, announcing its first ever dividend and issuing a stock buyback this week, sending the stock rallying. To break down what this means for investors, we've got Yahoo Finance's very own Julie Hyman. Hey, Julie.
Hey, Brad. It's great to see you. Great to be here. So let's talk about what this dividend and buyback are. First of all, as you said, it's the first time that Alphabet has ever issued a quarterly dividend. It's going to be 20 cents. It's payable on June 17th to shareholders as of June 10th. So what does that mean? You have from now until June 10th to buy the shares if you don't have them already. And then on June 17th, you would get 20 cents from Alphabet for every share that you hold. As for the buyback authorization, that's $70 billion. It's the same as it was last year. And a buyback authorization doesn't mean that they're necessarily going to buy back $70 billion worth of their own shares. It means that they can, when they see opportunities in the market, they have that authorization coming from the board. So let's sort of dig into this a little bit more, how a dividend works, how a share buyback works, and why companies do them. So taking the dividend, first of all, you have to get approval from a board to do any of these things for the company. And basically, you get a piece of the action. That's all it means here, is that if you hold shares in a particular company, you will get, again, that set amount per quarter for every share that you hold. In the case of a buyback, and it's basically a little reward for holding those shares, and it's a sharing of the profits of the company. A buyback is a little bit different because those profits do not flow directly to you. It's more indirect. So when a company buys back shares, they reduce the total shares outstanding. Less supply of shares means it tends to boost the price, and it also tends to provide a bit of a floor underneath the shares. It's also a signal potentially from a company that it thinks its shares are well valued, and so that's why it's stepping into the market. In terms of specifically for Alphabet, what this means, we have to put this in context that a lot of big tech companies do not pay out dividends because they are viewed as growth companies. And as growth companies, they tend to reinvest their profits in the business. They don't pay them out to you because they're focused on growing, right? And we also learned that Alphabet saw a huge increase in CapEx, capital expenditures, in its first quarter because it was doing just that, investing in AI, but it's also now decided to pay out this money. So the fact that a big growth stock and tech company like Alphabet is now paying this out could also signal, according to some analysts, that they do see slowing growth ahead. So they need to offer you a little carrot in the form of this profit sharing, perhaps to soften the blow of that potentially slowing growth. We don't know that. That's sort of the implication. So that's an interesting way to read into this. If you look at dividend yields of other large cap tech stocks, a lot of big cap tech does not necessarily pay out dividends here. Here's a few examples. And the dividend yield is effectively the amount that a company pays out in dividends annually divided by the stock price. NVIDIA's is very small because the stock price has gone up so much. But that company pays out 4 cents in quarterly dividends. Meta just announced the prior quarter its first ever dividend. Its dividend yield also relatively low, as is Apple's. You compare that with the S&P 500's dividend yield at about 1.4% and the NASDAQ 100, which is tech heavy, at about 0.9%. So these companies are paying out lower dividend yields, and there are higher dividend sectors like real estate and banks, for example. But that just gives you an idea of the landscape. All you ever wanted to know about dividends, and probably a little bit more, Brad.
It was the perfect amount. I mean, that's been a major question for a lot of investors over the course of this year. Do they even dividend, essentially, to summarize it? Because now, for some of these companies, it's a way to cozy up to the investor that looks at dividend-paying companies as a thematic strategy.
And one more thing I should mention, too. There are a lot of dividend strategies. They're usually called sort of equity income strategies because you're getting income from your investment. There are a lot of ETFs built around that. There are a lot of mutual funds built around that. And Bank of America noting today, in its note reacting to this, that per their Savita Subramanian, who's their portfolio strategist, that 40% of actively managed U.S. equity assets are equity income funds. They focus on those dividends. So this potentially means that Alphabet is now eligible for inclusion in those funds, and that could give a further boost to the shares.
Indeed. Julie, thanks for breaking this down for us.
Of course.
Very important information on dividends and buybacks there. We've heard a lot about that over the course of this earnings season.